What is private equity and how does it work? For wealthy people, playing the same game as everyone just doesn't cut it anymore, which makes sense because it's this kind of competitive reasoning that got them into the 1% in the first place. As a concept, private equity can be considered an offshoot of that nature of reasoning. So, what exactly is that and how does it work? In this video on private equity, you're going to learn all about that and more. You'll learn about its upsides and downsides, and if it's something you can get into. Before we get started though, make sure you like and subscribe for more. You surely wouldn't want to miss our next video. So without further ado, what is private equity? Well, it's a type of investment in which people create a special fund to buy and sell entities that are not publicly traded. That sounds like a handful, we know. But, phrased another way, it's a type of market in which prototype goods have special early availability to a select group of people. In purchasing the goods first, these people take a risk to assess if they're any good. If this proves to be true, then they'll be able to resell at a higher price. Private equity firms usually back private equity. These are investment management companies that provide the financial backing for this nature of investment strategy. They are typically organized as limited partnerships, and they put their money behind funding startups and acquiring promising companies. Moving on, how does private equity work? Well, the statements before should have given you a clue. It all comes down to the private equity firm and what strategies they employ. Though all private equity firms have a similar base business model, these are further diversified into venture capital, growth capital, leveraged buyouts, and even real estate. Now, what do all these terms mean? Furthermore, what do they mean concerning private equity firms? Well, let's dig in and find out. So, for a private equity firm, venture capital is a strategy in which investments are made into new companies and startups. This strategy is usually very risky, as these companies have no track record of profitability. If it works out though, it could end up paying big. About 90% of startups die. Those who succeed tend to be incredibly valuable. Next we have growth capital. Contrary to venture capital, growth capital involves investments into old, well-established businesses. Sometimes these types of companies need capital to move into a new market or growth area. Unlike venture capital, growth capital is a minor investment and not as risky. And then we have leveraged buyouts. This investment strategy is kind of a hybrid between venture capital and growth capital. What happens here is that a private equity firm puts a significant amount of money into buying a well-established business. They hope that, under their management, the company will appreciate enough in value to net them a profit. Finally, there's also real estate. This business strategy needs no introduction. For private equity firms, it's more complicated than simply buying property and selling it. Often, at varying degrees of risk, private equity firms undergo massive real estate endeavors that involve dramatic structural transformations. Now that we understand private equity, why private equity? Well, a lot of private equity firms bring in their management skills as their expertise. This is because businesses, new and otherwise, may sometimes go through turbulent periods where their leadership is lackluster. When a private equity firm takes over though, they can usually back their ownership of a business with competent decision-making. A private equity firm is usually insulated from the daily frustrations concerning the most basic levels of the businesses they own. This out-of-the-box perspective allows them to read market trends better. And so, having this unique oversight, a private equity firm can competently handle all the business decisions. They can thus negotiate transactions flawlessly, giving employees the freedom to focus on their work. Another benefit of private equity firms is that they provide portfolio oversight. This terminology means that they handle a company's assets, such as stocks, bonds, commodities, and cash. As a company grows larger in scale, it may come to trade in these assets. If this aspect of the business isn't handled correctly, the company may not survive the transition. There are a lot more complexities when it comes to private equity. However, by now, you should be pretty well informed. Now comes another important question though. Could private equity be for you? The answer, predictably, is that it depends. With their business model, private equity firms can make lots and lots of cash. The downside, though, is that there can be a tremendous lack of transparency. Private equity firm heads can also sometimes treat their holdings with coldness. This myopia leads to a disconnect from the reality on the ground, causing some rather callous decision-making. In the final analysis, private equity as a business model is wildly successful. There's much money to be made, either as a manager or as a financial backer. Of course, private equity will always have its doubters and its critics. Still, if anyone is looking to get in, the timing has never been better. Coming to the end of this video, we hope you have come to a decent understanding of private equity. We tried to make this as comprehensive as possible, even though there's a lot more to learn. Have any additional piece of information to add? Feel free to discuss below. Before you go, like, subscribe, comment, and share. You wouldn't want to miss the next video. Until then, take care. Later.